fellow investors. Welcome to Ritter on Real Estate. I'm very excited to have my guest on today. He's kind of a local legend around town here. I think everybody in Indianapolis knows who my guest is. And so without further ado, it's Sterling White. He's the principal of Sonder Investment Group. He has 18.9 million in assets under management, which includes 400 apartment units throughout the Midwest. He's also a Bigger Pockets contributor, and he's a former world record attemptee. So we'll have to dig into that a little bit because that's a very interesting fun fact. So thank you, Sterling, for being on the show.
Yeah, so everyone go ahead and strap your seatbelts in and also tie your shoes as tight as you can because we're going to take you along for a ride.
Right on, man. Well, awesome. So I want to start there. I want to start with your story. So help our listeners understand a little bit more about you and maybe sprinkle in a little bit about that world record too.
Oh gosh. So yeah, quite a bit. I'll give everyone a Cliff Note version. So born and raised here in Indianapolis, Indiana. Kent mentions a legend. I don't know about that. So much more to go, of course, but born on the not so good parts of the city where you wouldn't want to walk your dog at night or even during the day. And when people map out Indianapolis, they would put that in a red zone. But in essence, is single mother, fraternal twin brother, grew up in Section 8 housing, welfare, food stamps. And I just remember at one point, Kent, my brother and I, we were actually sitting down we're about 5 or 6 years old in the dining room, eating like Roman noodles and cut up hot dogs. And then as soon as we go upstairs, a bullet comes right through the back patio where we were sitting. So I may not be here, he may not be here, but just ended up using that as fuel versus being a product of the environment. Entrepreneurship came into existence for me. That whole spirit was I had to figure out a way to earn money in the legal sense. First product was Kool-Aid. Second was Pokemon cards. And fast forward how I got started in real estate. This was 2009, construction side. Shortly after that, got into the investing at 23 years old, bought a single family house, no money out of pocket. Fast forward from that, 150 single families. And then in 2017, made the entire shift to multifamily. And the very first deal I acquired in 2017 was a 46 unit deal. And fast forward to where I am now is the most I was at 600 units and have since sold some and now just under 400 units at this present time. So more than happy to go back to the world record attemptee, but I know there's quite a bit to unpack there.
No, man, that's obviously an awesome story of resilience and of just the entrepreneurial mindset, which I love. I mean, you were hustling from the beginning with Kool-Aid and Pokemon cards. So you're probably a force to be reckoned with out there in the schoolyard. So a couple things there. One, okay. So what is the world record? What was the attempt? I'm super curious.
Okay, so I read this book called The 4-Hour Workweek, which is by Tim Ferriss. And along with other practical things I got from it was picking a goal that scares the absolute, this is probably not, so I'll keep it crap out of you. So I don't want to have the E sign next to this episode on iTunes. But from that is I picked one goal that really scared the living crap out of me, and that was attempting a world record. And so the record was world's fastest fireman carry mile. So what I do is I'm not a fireman, for those of you who are curious. I just carry someone in a fireman's position. And those of you who are visually seeing this, you can actually do it. Those of you who are not, you'll have to hop on YouTube or somewhere else. But in essence, I carry someone of equivalent weight, fireman's position, and I have to beat a specific time, which was 11 and a half minutes. So that was that attempt. A year and a half I was training for it. Day of the event, I'll just spark note version. So I dropped the person halfway through the attempt. So the attempt was over. But what I ended up learning from that experience was, one, failure is not so bad. There was newscaster, there was family and friends out there, a huge event. And then two is there was so many adversities that I had to face leading up to that. One, my back went out 3 months into the actual training. So I was bed rested about 2 to 3 weeks. And then also 2 weeks prior to the actual event, the person I was training with actually backed out. But I just kept pursuing, and then went for that attempt. And yeah, it was a huge unlock and a light bulb for me. And those highlights in my journey.
Oh man, that's awesome. I think there's so many good lessons there, right? That you call out, and I think taking those into your career is probably why you've had the success that you've had. So getting into in the investing side of things. So you mentioned you had 150 single family homes.
Yes, here in Indianapolis and Dayton, Ohio. Would not, if I were to go do it again, I would do it again. But I tell you guys, there's a lot because it was self-managing at the same time and still acquiring.
Oh my gosh. Yeah, that I can't even imagine. So probably I know the answer to this, but like share with our listeners, what was it that made you make that flip from single to multi, and why has multifamily become your investment of choice?
The first one is economies of scale. So I've purchased 46 individual homes and that first deal, which was a 46 unit apartment. I'll tell you that it was a lot more seamless, one buyer, multiple doors in one location versus with 46 single families. There was close to about 35 to 40 different transactions. They're all scattered throughout the city of Indianapolis. If maintenance comes in, repairs, you got to go over here, you got to go over there versus with apartment. So it was that. And then also it's just easier to scale in terms of where we were looking to go, more efficient through the single families than the multifamily. And then also it's more treated as a business on the multifamily side versus the single family from a exit standpoint.
How have your returns differed from your single family life to your multifamily life?
I'd say the returns were the same, in meaning that our cash on cash, we're always looking to be just at the double digit mark. And then when exiting, like the internal rate of return to be closer to about 20 to 25%, or I would say closer to about 20%. So the returns on both have made the most, it's translated.
Gotcha. So you haven't seen a difference from a return profile. You see fairly similar, but what you have seen are a lot of savings just from expenses and time, it sounds like, right? You talk about economies of scale, driving that home, meaning that you're spending less time, less energy, less cost per unit by focusing on multifamily and getting all those doors under one roof, right?
Yeah. Exactly. And when we were on the single family, that we had to build a whole entire acquisitions team. We still have the same thing on the multifamily, but it wasn't even close to how it was on the single family.
Oh, right on, man. So as we kind of left off, you got into multifamily, you're at your 46 units. Then you scale up to, you said you were at 600 at one point, right? So what was talk me through the process as you went from that first 46 and scaled up to the 600. I mean, what was it that, how did you change your process as you went through that and as you scaled up? I mean, how did business have to change?
Yeah, I would say had to transition our business from the single family. So no longer own the single families, but also telling the team, hey, we're no longer acquiring those. I'm saying those, but no longer acquiring single family. We're focusing our efforts moving forward to the multifamily. And then also we tweaked and just going direct to owner. That was another big approach that we took too, and just expanding to other markets, because there's only a finite of apartments that are in, I would say, C plus to B minus neighborhoods that are 75 to 160 units. So from that, we could have kept digging into Indianapolis, but from that, we decided, okay, let's expand to other markets so we can build that top of the line in terms of the pipeline. That way, because the more contacts we make, the more likely it's able to lead to a contract.
Yeah, that makes sense. So what was it from a market standpoint, as you were looking at,
like Louisville, we expanded to that
like
one.
you've got your multifamily, or you've got your 150 single families, you're getting into multifamily. How did you start out deciding which markets you were going to be in, and what are the things that you're looking for in markets to say, hey, that's a market that I want to be in?
Yeah, so it is looking for markets very comparable to Indianapolis. So staying in the Midwest, and the common ones, economics is job growth, rent growth, population growth, what's the unemployment rate. So looking at those measurements, but also the most important thing is the price per door in correlation with the actual rents. Meaning that if average rent on a specific property is 750 or 800, we're expected to be all in anywhere between about 45 to 50,000 on a per unit basis. So that's what we're looking at also in the C plus to B minus neighborhoods. And so we're looking from a top level, the top economics of the market. And then we go even more deeper and say, okay, these are the neighborhoods. What does it look like on a price per door? Meaning if we were in New York and it was renting for, I don't even know if the rents are out there, 750, 800, their price per unit is probably what, 150, 200, 250?
Yeah, or more, I imagine. Yeah. No, well, very good. Hey, real quick, can you hear that? Can you hear something on your side?
It was a little beat, but
No,
it's not, no.
they're like, hold on. My wife's like running the vacuum out here. It's super distracting for me. Let me be right back. I didn't know if you could hear it or not. All right, man. Sorry about that. First time I've ever done that in the middle of a podcast, but we'll just they'll just edit that chunk out. Yeah, sorry. I started running the vacuum, and I was like, I thought I was hoping like it wasn't coming through the audio. I'm glad you couldn't hear it. It was super distracting for me. So, what I'll do is I'll clap, and then that way the editor will know kind of, this clap and that clap. They'll cut that out. So I'll clap, and then let's just start again with so talking about market, and then so the next question I'll ask you is around just getting into, I guess what I want to know is, so we talked about market. I want to know more about as you're looking at a particular deal, what are the things that you're evaluating, and let's talk through that criteria a little bit, and like what are maybe are there some things? Well, let's go there. Then I'll ask you the question. All right.
Okay.
Well, so Sterling, so understanding, I think that's great how you're looking into a market. As you dig into the particular deal, what are the things that you're looking at and evaluating? And as you've purchased your 600 units, I mean, have you started to see themes of like these are the metrics that really matter? These are like common themes I see in my apartments that are make one a success versus another?
Yeah, I would say one is when looking at a deal is the whole value add, which is thrown around quite a bit, but looking to see if there's a rent premium anywhere between $75 to $100 pushing the rents up. In addition to that is the cash on cash minimally to our investors has to be in the double digits. So anywhere minimally 10 to 11%. And that's average across the board. And then also when we sell the property, it's closer to about 20% is in terms of previous deals and what our expectation is. So those are from like a actual deal analysis, and then looking at what are the schools, in addition to what's the actual neighborhood as well in terms of is there high crime. So looking at those analysis, and then from there is I'll have to backtrack. I don't know if I can mention returns now that I think about it. I went too much into the trenches. So if we could clap and then ask that, yeah.
Well, you know what? I'll go back through at the end, and then I'll just have them cut that section out.
Okay. Yeah.
Where you talk about the returns. That's cool.
Yeah, I talked.
We can just. Well, yeah. Do you just want to do that whole question over? You want to start over?
Do that question over again.
All right. Sounds good. So I like how you can just do that. Now I have to do it again. Okay. So Sterling, as you're evaluating deals and getting down to this particular property, I mean, what are the things that you're looking for on that property that that make you think that this deal is going to be a success? I mean, are there things as you've acquired your 600 units that you start to see in common among properties that have done well?
Yeah, I would say is that they're mom and pop operators. That's always been our go-to in terms of one, the operator is mismanaging it, and they also have a motivation, they're a high desire in selling the property, which allows us to solve the problem and then get the property at a discount. And then as far as the rents being anywhere between $75 to $100 in terms of being able to push those up. And then also minimally, I'm a cash flow guy. It's double-digit returns on the cash on cash to our investor partners. And then from a deeper level during due diligence, we're looking how's the crime rate, what's the vacancy rate that's there in that specific location. And then also, what is the median income to ensure that it actually does support our increase in the rents as well. But one thing is there is a team involved. It's not just myself. And that's always the crucial and vital point, because I've made a $1 million mistake on a deal, Kent. And this is a personal lesson for everyone that's out there.
Yeah, do tell.
This was 156 unit. Luckily, we were still able to acquire it here in Indianapolis, in which submitted an offer to the owner. This was $7 million. And I was the one doing majority of the underwriting. And once got the team involved, they said, your rents are a little bit too aggressive in what you believe you can push those up to by about $75. So $75 across 156 units times 12 months. That was a huge swing. So ended up having to go back to the seller, and they accepted a concession. But still, that's one of those things is why it's important to have a team involved, especially the double check things.
Yeah, absolutely. I mean, I think the team is critical. And I think I'm glad you had a seller that was understanding and allowed you to come back and still get that deal done. But I think finding that out ahead of time before closing the deal, right? That's exactly what really matters. I mean, at the end of the day, right? So having that team to support you, I can't agree more that absolutely critical. So from, so you're taking on investors for your projects. I mean, what do you look for in an investor?
Yeah, I would say, and it's for passive investors that are on here and also operators too, it's during that initial call, we always have phone calls with our investors, it's an interview process. So they're asking us questions, we're asking them questions. The first thing is, if the person says, I'm looking to get my cash in and out as quickly as possible, that's not a good fit from the get-go. So that's one thing. And then also, if they want control and say, hey, if the market is hitting the fan or a correction happen, I would like to have say so in terms of, and they're very, very involved and very vocal, then that's one of those people that is most likely just not going to be a good fit, because we're the professionals, we're the ones that's doing all the day-to-day, we're in the trenches. So those are two key things that we're looking out for.
Gotcha. Yeah. So you've got to be willing to
easy to work with.
But yeah, you want everybody. I mean, you wish everybody is easy to work with, but you want investors that I think understand their role as a limited partner, right? Is what you're saying. It's they're investing because you're the expert, and that's why they're trusting your expertise, and they have to be realistic about timeframes, right? Like these are illiquid, longer term investments, and that's that's one of the drawbacks to investing versus stock market, where you can trade your money in and out, right?
Or just press a button and you're able to get your cash out.
Yeah, or press a button and get your cash out. But there's a lot of pros to those cons, right? I mean, I think that's what the higher return expectation is, right? That return premium based on that illiquidity. So I think as long as you're hitting those returns, I'm sure you're having no problem bringing investors in that fit that profile. So as you're I know you've done a lot of deals. You've done, from single family into multifamily. Can you share some of your lessons learned with the group? I mean, we talked about your lesson learned on the kind of the aggressiveness of the rent bumps. So what are some other things you've learned throughout the years that can help people, not make those same mistakes as they're investing?
Yeah, so I would say first, and this goes from a operator standpoint and also investor standpoint, is to be as be as transparent and communicate issues to your investors or problems that happen to come up as soon as you can, versus them finding out whatever the issue is. It's best to give the bad news versus have the investor find out about the bad news.
Yeah.
So I haven't ran into a case where they found out about the bad news, but I've learned that lesson from others and haven't replicated it. So that's one. From a passive investor standpoint, is if it seems as if your operator is hiding things or not fully transparent, or if they're, let's say they're doing monthly updates and they only do the updates 6 months, that could be from a communication standpoint. So we're regularly in touch with our investors. So that's one thing a passive investor would want to seek in an operator. And then the second is to always raise enough money to take care of improvements for a property. I heard this mistake from other operators, and this is the thing, is when learning from others, this is one quote I like, is that yes, it's good to learn from your own mistakes, but it's even better to learn from others. So
Sure.
there was this one deal, 50 units, in which the numbers were a little bit too tight, so we couldn't actually raise enough money to take care of the improvements. We thought we could take them out of cash flow, which was a big mistake. It ended up biting us later, and we had to sell, got investors good. But that was just one of those things that if we were not at the height of the market, it could have been a different story. So that's one thing. If the deal is too tight for you to raise all the money up front, just move on to another one.
Yeah. No, I think that's an awesome lesson. I think in my own experience, running into this similar situation, and wanting to, just the idea of, I think this idea that you can, you're like, oh, we'll do those improvements out of operations. Right.
Exactly.
And it sounds great up front, but it just doesn't work because, you're never going to have that. You're never going to be able to catch up that cash flow to really do what you need to do. And you're going to end up undercapitalized. And you're either going to have to do a capital call and ask for more money, which nobody wants to do. Or you're not going to be able to fulfill the business plan. Right. So I think that is, from the investor side, if you're hearing sponsors say that, I think that's a red flag. You want to have all your money up front to do what you need to do. And that's the safe conservative play.
Yeah. And I know people are going to still hear that mistake from the both of us and make the mistake themselves. And then they'll experience, be like, oh, that's why they said that. So but if you guys could put a star next to that, if have it just in the back of your head, is when a deal comes tight and that's happening, that Kent and I are just spinning around your head. No, there's not enough money in that.
Yeah. You can't fall in love with the deal, right? That's what happens to people is they fall in love with the deal, meaning you're trying to make the numbers work.
Looking over the red flags. Oh no, that's a red flag. Oh, we're good. Let me look at all the good things.
That's right. Like if you're at that point where you're trying to get that creative to make the deal work, then like Sterling said, pass on the next one. There's 100 other deals out there that you should do. And if you see that as an investor, if you see that in the business plan, again, like I think that's a thing to look out for. The other one I like to call out is just the assumed refi. I'll just throw that in there. I hate to see that in underwriting because there's just so much that could happen. You may not be able to refi, may not be the right time, may not be able to find the bank to do it. Rates may go in the wrong direction. So assuming that's going to happen and baking that into the underwriting and then talking about those returns, I think just is not the conservative approach to take. So, which I think if you're investing, you're thinking about your own money, you don't want to know what the best case scenario is, right? You want to know what the most likely scenario is. You want to know what the worst case scenario is.
Yeah. So protecting your downside and taking calculated risk.
Yeah, exactly right. Like it's more about, first rule is don't lose the money, right?
Exactly. And
And
rule number
so,
2 is refer back to number 1.
exactly right. Exactly right. Well, Sterling, what as you're looking into the future here, obviously, we're filming this right right after the election. We still don't quite know, how things are going to shake out. But what's your forecast as you've been looking out in the future? I mean, I'm not expecting you to, tell me who the president's going to end up being or anything. I mean,
I'm not getting into politics, Ken.
right. But just from your outlook and maybe referring back to your plan and your strategy, what do you think is going to happen over the next year? How are markets going to look, change? And then how are you acting, based on that?
Yeah, I would say one, whoever is in office, whatever gets pushed down in terms of their power or changes, taxes, whatever the case may be, it's still up to me to figure out, navigate, make adjustments. That's pivot as an entrepreneur, business owner, a human being. So that's one thing. And I still feel things are, especially here in Indianapolis, collections are good. The occupancy is good. Even with that, the certain regulations on the eviction side, everything's been fine. Nothing too alarming. So I don't feel like here in Indianapolis, things are going to skip a beat. Sellers' expectations are still very high in terms of their prices. They may start to come down a tad bit, but still there's people that are going to be paying premiums more than I would. So just steadily taking the direct to owner approach and going direct. And then also just always working towards my main mission, which is being an ideal and a message to those kids who came from the environment or in the environment that I'm in, that, hey, you don't have to take this path that many people take, that my brother ended up taking, is facing hard time due to that. You can take this path. This is how I took it. And here's the blueprint and the roadmap. So that's my big picture. North Star that I'm working towards.
Mm-hmm. That's awesome, man. I love hearing that. It's not, I mean, you're taking accountability is what you're doing, and you're taking accountability to say, no matter what the external factors are, I'm nimble and I'm going to figure it out. Right. And you're going to adjust and you're going to pivot, like you said. So
Yeah.
love that attitude.
And that was a question I asked my little one. So I have an 8-year-old. Just imagine me with a full head of hair, like Tarzan. And so I asked her, what are things we can control and what the things we can't control? And she said, we can control what goes on the inside, and that from that standpoint, but we can't control what goes on externally. So it's the same thing that goes back into the election. Whatever happens, it is what it is. But I know that whatever the case is, that me as a person, I still have to figure it out.
Yeah. Oh, I love that. I mean, you're teaching mindset to your 8-year-old, and that's that's what it's all about, right? Like that's the key to success. That's it. Just
just took my key to success.
Oh man. Well, I'm gonna steal your thunder, but it's the most important thing, right? I mean, like you said, you can control how you react to the situation. You can't control the situation, but you can control your reaction, and that's the key to, I think, being an entrepreneur and being an investor too, right? Is like, the worst thing you can do in the down market is panic and sell, right? You got to be able to hold steady and see through what's going on, have a vision, and find those opportunities. And I think that's what you've done, and I'm sure what you'll continue to do, man. So I appreciate you giving your wisdom here on the show today.
Oh, for sure.
So last segment that we have before I let you go is the keys to success. And, want to ask you a couple questions here and get your thoughts to help everybody else level up out there. So what is the one question that every investor should be asking their deal sponsor before they make an investment?
Oh, gosh. Man, you asked this at the beginning and I should have queued something in. Is tell me about the deals that didn't go according to plan and how'd you end up navigating through those? So that would be one question. I believe I've had that several times, and well, not several times, a very select few amount of times. And I would say to ask that more and really just understand from the operators of their response. Do they stutter quite a bit, or does it sound transparent in terms of what they're actually communicating. Because on my side, everything's not rosy. We do have our good deals and our ones that have had home runs, but there's been some deals that done okay, and we've had to make pivots just due to the market. And that's just one of the names of the game, but it's how you exactly pivot during those tough times.
Yeah, I think that's a great question. And you're looking for, sounds like, one, their response. I mean, are they being honest? Are they being transparent? But two, yeah, their ability to pivot and be nimble. I think that's a key quality to any sponsor success. So I think it's a really insightful question. Next question is, or answer. Next question, what are you most proud of in your career?
I would say what I enjoy most is the DMs and the people reaching out to me via email that say, thank you so much, Sterling, for the information that you put out there. I've been able to get my first deal. It's changed my life, my mindset. I've been able to overcome limiting beliefs. So that's what I would say I'm most proud of, in terms of, I really don't look at myself as like a motivational speaker or anything. I just share my story in hopes that it does provide some fuel and insights to others that, hey, wherever you are in life, that there's still a way for you to get to where you're going. Instead of complaining, just ask better questions. How can I do something, versus just complain and not do anything about it?
Mm-hmm. Awesome. And what's one book that everybody should be reading?
If you haven't read it already, there is a book, Shoe Dog, that is by Phil Knight. Have you read that book, Kent?
No, I haven't. I'm gonna have to check it out.
Yeah, it's a fantastic book. It's Phil Knight is the founder of Nike.
Yeah.
And this was one book I read, and I stayed up all night, multiple nights reading it. And it felt like I was actually there in multiple times. It was that well written.
Awesome. Yeah, definitely adding that to the list. And last but not least, what is your number one key to success?
Mindset. Huge. I feel I could share all the tactics, the strategies, the tools, but if someone doesn't have the right mindset, it's like a thermostat. Their mindset, they could be capped out at 50% or at 50 degrees. And in order for them to get that first deal, they need to be at 60 degrees. So they'll always find some way to sabotage themselves if they don't have the necessary, let's say they have a limiting belief, or let's say someone wants to be a millionaire. However, they have a limiting belief that says wealthy people are bad people, or rich people. In order to get to that point, they have to do unethical things. And if
money is evil, right?
Yeah, exactly. Money is the root of all evil. So it's one of those things. That's your thermostat. So if you're at 50 degrees, and in order for you to become wealthy, you need to be above that. And unless you don't have the right mindset, you'll never get past that threshold. So.
No, that's awesome, man. I couldn't agree more. One follow-up bonus question to mindset. What do you do to develop and maintain your good mindset?
I would say, one, I don't watch the news in terms of what's going on with the election, all politics and that. I understand to a minimal, like on a high level, because people inform me and all. Yeah, I don't want to go there, but I didn't even know the NBA playoffs was the NBA playoffs until like when the Lakers won the championship. So that just goes to show you how much so that's one thing, is cutting out the news. And then on a daily basis, I'm always listening to something that is self-improvement. And what really helped me in my early 20s, when I took a different trajectory in life, when I had this like good experience well, not good experience, but this aha light bulb experience, that I started on the self-improvement path and really started feeding my mind positivity, replacing a lot of limiting beliefs with more empowering ones.
Yeah, that's awesome. Awesome. So keep the garbage out. Don't listen to the evening news, right?
Yes.
Or really most of what is out there these
Majority,
days.
But yeah.
And two, then feed yourself positivity. So you listen to something positive every day.
Yeah. Right? And third is cutting out, if someone is toxic that's around you, even if, I don't even want to say family member, but even if it's friend, you just have to cut them out, because they're just going to keep draining you. And it's like crabs in a barrel, I believe is the analogy, is you're that one that's looking to get out, and they'll just grab you right back in.
Yep. Yeah. I mean, there's so much to that. Like, I mean, maybe it's cliche, but you hear about, you are the average of your five closest people or whatever it is. But I think that really is true. I mean, you're going to achieve or basically not achieve similar things to what those around you are doing, right? So you surround yourself by good people, keep positivity, feeding yourself positivity, and keep the negative things out. And yeah, man, I think those are all great tips. I appreciate you giving us those little tidbits at the end. Well, Sterling, man, it's always a pleasure to connect. Thank you so much for coming on the show and giving value to our listeners today. How can folks get a hold of you if they want to hear more about your story?
Yeah. So one is you can follow me on Instagram. It's Sterling White Official. One more time, that's Sterling White Official. And then also my company website is sonderinvestmentgroup.com. That is SONDR investmentgroup.com.
Awesome. And we'll put all that in the show notes so that you guys can reach out to Sterling. So Sterling, thanks again. And always a pleasure, man. Can't wait till next time.